Well, welcome back. Today I'm joined by Nahashon Mungai, who is from, is it Sterling Investment Bank?
Standard Investment Bank.
Standard Investment Bank.
Yes.
And he's going to help us make sense of the global markets today. Karibu sana bwana.
Thank you, Ramogi. Thank you for having me.
Lovely. There's a slow start in markets across the globe.
Yes.
I was looking at the figures, whether it's the Asian markets, the European markets, the American markets.
Yes.
Could you help us make sense of this?
Okay, so what we're seeing in the global markets right now is really a spillover from what we saw towards the tail end of last year, where we started having inflationary concerns. Yeah, I'm sure you noticed that the US, for example, right now we're at an all-time high in terms of inflation rates at 6.8%.
Yeah.
That's the highest inflation rate we've had in the US for the last 21 years. So this obviously has created concerns around how are central banks going to react to this. Typically, central banks might react by increasing interest rates, or as the Federal Reserve mentioned they would do last year, actually stopping the quantitative easing program. So the quantitative easing program is essentially just what has been keeping markets alive by printing money. That's a fancy way for saying printing money.
Absolutely.
Yes, so now if they stop printing money, then what happens to the stock markets? So that's a concern. So investors are now getting a bit more conservative in how they approach markets. Now, what caused this inflation? So this inflation is really what was caused by supply chain constraints. So it's a very interesting type of inflation because you have supply chain constraints created by China, because China has a zero tolerance policy on COVID. So if they get even one case of COVID at a port, they close it down. So you have less ability to supply goods from China, and you have open markets in the US where consumption has gone back to its peak. So obviously then this causes a disconnect. There's a disconnect, and that disconnect now causes inflationary pressures. So this is really what has affected markets. So interest rates have been ticking up. Last year at this time, the 10-year US Treasuries were trading at 0.9%.
Yeah.
As last week, we were at above 1.8%. So you see, this is a really high figure. And if you think about the average dividend yield on the US stock markets, it's just around 2%. Now interest rates in the bond market start competing with dividend yields. So suddenly it doesn't make a lot of sense to go into the riskier stock market.
Yeah,
You'd rather go into bonds.
Absolutely.
So that's one of the reasons why, that's actually the main reason why markets have slowed down a bit.
Yeah, I have observed that the UK is talking of a two-digit, 10 point something inflation.
Yes, yes.
And this is all still perhaps due to the COVID-19.
This is essentially across the world right now.
Yeah.
All this is supply chain, all around the world.
Are we perhaps going to see a lot of this going on into this year and perhaps next year as well?
Well, definitely there's, even if China changed its zero tolerance policy on COVID, there would still be a lag effect. So this will continue to be an issue. But then markets have a way of just being resilient about around some issues, because I mean earnings numbers are still pretty good. Most stocks are still, most companies are still performing very well.
Yeah.
So eventually investors will always just go back to the question of, is a company valuable or not? And then we then expect that the markets should then recover based on that narrative. Interesting.
Let's go to perhaps then the the sectors that you see doing well. Are we looking at better performance in, is it oil and gas, is it tech? What are the sectors that intrigue you?
Well, this year we'll be looking, yes, at commodities. We expect that oil prices will continue going up. Right now oil is trading at around $85. We expect that oil prices should actually go above 100. In fact, some projections have it as high as 150, but we just want to think at least we'll go above 100. Yes, conservatively.
By when?
Oh, this is short to medium term. Yeah, oil prices could aggressively go up because again you have this reopening of these economies, and then a lot of consumption is back up essentially. Yeah. So yes, for sure we expect oil prices to go up. We'll also be looking at commodities like gold. One of the effects of investors getting very conservative due to lower performance of stock markets is really just capital flowing into safety assets. So gold is considered one of them. Right now we are trading at around $20 an ounce. We expect eventually that gold should trade at around $2,000 an ounce. So we'll also be watching this very carefully. We expect that the dollar should continue to strengthen. Again, as a flight to safety, you know, you sell stocks, you hold your cash in dollars typically.
And conversely, of course, the shilling will take the hit.
That might have an effect on the shilling, obviously. Yes. And then we'll also be looking at bank stocks. We think bank stocks should benefit from high interest rates. They're one of the few stocks that should actually benefit from interest rates going up, because then they can reprice their debt higher. So we'll be looking at US banking stocks. Although, of course, the last 1 week, well, took everything down, including the bank stocks. But we think that, yeah, exactly. But we still think that the JP Morgans, Goldman Sachs, Morgan Stanleys should benefit from higher interest rates. So we'll also be carefully watching those.
But the tech stocks don't look attractive to you. I thought the technology sector is doing much better now.
Yes.
That, you know, after COVID-19 locked us all in, we all went to technology.
Well, that's true. The only argument against tech stocks is just how highly valued they then became. You had stocks, I mean, you had stocks moving as high as 500% in a year. So now you have very high valuations on some stocks that have actually represent companies that have actually never turned a profit. So, I mean, if you look at some companies, like say Snapchat, for example, or Spotify, you know, they're actually not profitable. And then their valuations were very high because of the COVID. So the COVID was good for tech stocks. But now with COVID receding as a narrative, then tech stocks become less lucrative stocks to own because they have such high valuations. Most of them are plummeting by more than 50%, just to go back to their original valuations.
It's just a correction of sorts.
Yes, the corrections, yes. So, well, we think right now you'd rather even be looking at defensive stocks, like utility stocks or consumer staples, because those will continue to do well, especially in a high inflation environment.
Is it a much better bet for me if I went to the bond market instead and you know, stayed safe and just bought from governments?
Well, maybe in frontier markets like ours, there's some benefit there. Like you saw today, the 20-year paper came out at a yield of an average yield of 13.79%. But if you're looking at Western markets, then that narrative doesn't really make a lot of sense, because interest rates are still pretty low. I mean, if a 10-year paper is at 1.8, I mean, it's still, you have more chance making money in the stock market still. I mean, if you look at the performance of stocks last year, I think I have some numbers here. If you look at Pfizer was up 60%, CVS up 50%, Microsoft up 50%. Stocks will still beat bonds in the long run. Even if you have a bearish period, for an investor, it wouldn't make a lot of sense to diversify fully into fixed income.
You've talked of commodities. Allow me to go a little bit in the back from in the conversations we've had. If I bought, for example, gold today and oil today, you imagine that I'll probably be a lot richer by the end of the year? Yes,
that's our expectation. Our expectation is that commodity prices will be rewarding for investors.
But let me deviate a little from the global market to the Kenyan market. I am a Kenyan. Does it mean then that if I went, for example, and bought maize and kept it and NCPB for a while, will the same principles apply?
Okay, but you know, maize is different, because maize is really, those are dynamics of supply and demand now in the Kenyan context. And so, well, you'd have to have really studied the Kenyan market. You'd have to know how the weather is. But if then you're talking about going and buying petrol and hoarding it, maybe that could actually be profitable for you.
No, I'm not interested in hoarding petrol, but it's just crazy. I'd prefer to hoard maize. But anyway, to what extent do you see the markets shrugging off COVID-19 in 2022? I know we've already mentioned that, that the pressures we are seeing now, the reverberations of the effect of the COVID-19 pandemic. But to what extent do you think that it will shrug off the pandemic?
Well, that has already happened. I mean, if you look at last year when the year started, there was a bit of a dip in markets again. But now last year, the conversation was around the Delta variant of COVID. That's what had scared markets. Then we dealt with that. So markets rallied and the S&P was hitting all-time highs again. Then towards the end of the year, again, we had Omicron.
Yes.
Omicron came and then everyone was scared again. Markets dipped just for a few days and then shrugged it off. Now we are still in the shrugging off period. So right now, conversations on markets right now do not include COVID as a concern. The only thing, of course, COVID did for us is create now that supply chain constraint. But that's really also due to China's zero tolerance policy. So
it's more of a policy issue than
it's more of a policy issue than a health issue. So we don't have lockdowns, but you have created a situation where we can't go back to normal global trading because you're closing down your ports.
Okay. Wealth transfer. There was thought that, after COVID-19, a lot of wealth will be transferring from one hand to another.
Yeah.
They were saying that the emerging markets will become stronger because we will be more resilient. We will have created our own manufacturing plants.
Yeah.
I had the president boast of some of those developments in December.
Yeah.
To what extent do you see this happening, as attracting more investments in the global market now that the other areas are suppressed?
Well, that's definitely true, because it created the need for emerging markets and frontier markets to start taking care of your own business. And we were so used to importing goods. When COVID hit us, it occurred to us that we really have to increase capacity locally. And I know the government is committed to that now. So yes, I agree with you that that sort of conversation has taken on more urgency now, and definitely that will lead to should lead to a growth of the sorry. Yeah, so that should improve the local manufacturing capacity. Yeah, for sure.
Significantly so.
Significant. Yeah.
Now, but on the other hand, you hear that our performance, especially in terms of attracting foreign investors in the stock market last year, we did not do too well, that the foreign investors' interest in the stock market is going down. I don't know what your comment is this in light of the global market. I thought that perhaps when the global markets are suppressed, then smaller markets like Nairobi would be able to attract more investments.
No, this is really a factor of portfolio management, because if I'm running a hedge fund in Europe, I will have portfolio allocation limits. And if markets have dipped to a certain level, then my systems will most likely also reduce the amount of risk, because we are considered risky markets. When foreign investors are investing in our markets, they're taking on, according to them, a higher risk on their portfolio. So what happens is, if markets generally are not performing very well, which is what was happening, then their risk allocation is actually reduced. So they might want to invest more in Nairobi, maybe if they see the opportunities, but their risk framework does not allow them. So it's really a factor of global markets. So sometimes if the world markets catch a flu, we'll also catch a cold. because of the way portfolio allocation techniques generally work with most mutual funds and hedge funds. That's how it works. So even if I'm a trader somewhere in London, even if I know, yes, Nairobi, the opportunities now, I'm not allowed to by the risk framework that I'm given. Yeah,
I know I'm thinking village while we are talking global, but just indulge me a little more. In what ways then can we reduce the risks in our market so that then we can attract these portfolios into the market?
Unfortunately, the risk is really just your country rating. Okay, you can only be as good as the rating of your country. So if our country is rated B positive, then that again can only allow you to get a certain level of risk appetite from a certain fund manager in all your assets. So there's nothing you can do about it. So if your risk rating is low as a country, then which is what you call your sovereign risk rating, then all your investments are then pegged to that. So it's always going to affect you, unfortunately, no matter how well you do in your markets.
Yeah, so the buck stops with the government at the end of the day.
Yes, and the guys at Moody's. we should talk to them and they will fix all our problems.
I doubt if they'll be able to fix our problems if we haven't fixed ours. We have to take a break because we've been at least 15 minutes into the show. Interesting conversation about the global markets. When we come back, we'll touch on the World Economic Forum and some of the discussions that are happening there. Don't go away. Join us in a few.